Good, good, good. Again, guys, my apologies. We were just getting the quick fix on John's audio. Again, welcome to our Closing Bell webinar. And like I had said in our post-market update today, we have a fantastic guest right with us today. We have special guest and good friend of ours here, Jonathan Rose from Active Day Trader. Now, Jonathan, obviously, he had started off locally in Chicago, actually, in a Chicago-based trading firm. About a smaller company, but he worked his way up there for roughly almost a little bit over 10 years at this point. Became an equity options market maker on the CBOE. And to this day right now, I mean, he is a fantastic options trader today. Now, the topic of Jonathan's webinar is swinging for the fences, generating huge returns with mispriced options. So essentially what he'll be going over is the opportunity to profit with mispriced options, how to scan the markets for these unique trades, and how to take advantage of huge volatility. So John, are you there?
I am. Thank you. I appreciate the intro. Okay, everybody can hear me okay as well? Okay, great. Thank you. So yes, thank you. Thanks for having me, and welcome everybody to the webinar, Swinging for the Fences: How to Generate Huge Returns Through Mispriced Options. Just go through a risk disclaimer real quickly. I'll just read the first couple of lines. Trading or investing carries a high level of risk and is not suitable for all persons. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. I think, as we know, these are educational webinars. Whenever I talk about a specific trade or level, it's just where I see value in the market. So again, my name is Jonathan Rose. I've been trading professionally for 18 years. I started my career on the floor of the Chicago Mercantile Exchange, trading NASDAQ futures for 5 years. And then after that, traded fixed income. And then for the last 4 years, I've been a market maker on the Chicago Board Options Exchange. Thank you, Alex. What I'm going to be talking about today is from my time at the Options Exchange, because I started at the CBOE in 2011, which was a really good time to be a professional market maker, because if the last trade of an option was $1, the market makers would be 60-cent bid at $1.40. So that's a really good market for a professional, but then the retail players have to either sell 60 cents or buy $1.40, because that's a very wide market. Well, in 2012, that 60-cent at $1.40 market might have been 80 cents at $1.20. Until 2014, where the markets kept getting squeezed and squeezed and squeezed because of automated trading and because of technology was trading the markets to such a great extent that there was no more edge being a market maker. And that's when I left the CBOE and jumped to the retail side, because I feel like a lot of the automated market making are making markets almost too efficient. After the top 30 or 40 names, they're still pretty tight markets that are great for retail that we can trade, but they're really volatile. And as a professional, I don't want to be making markets on those. Don, yeah, I believe that this is definitely being recorded. So this is what we're going to do today. I'd like to introduce to you just a straightforward strategy that I feel will help you. Absolutely no options experience necessary. Everything we need we will go over today. The approach is just looking to buy little out of the money options, either calls or puts. This is how I learned how to trade options. So this approach builds the foundation to trade options forever. And I encourage everyone to think in terms of your overall portfolio and hopefully view the market in a new way, not to look every trade as, trade, taking a step back and looking at all your trades together. Now the chart here on the right is just showing the exponential growth of the options market since options started in 1973. And you can see really starting in 2000, just a huge growth of the options market. And in 2015, that was actually the first year where options overtook equities as far as notional value. So options are now 50% of the overall market. So if you're not following the market, and I'm not talking about trading, forget trading, just to be following and being aware of what's going on, I think you're really putting yourself at a disadvantage because, again, that's half of the overall market now. So this was my wow moment or my aha moment with this strategy. So in front of you is a stock SRPT. When I was on the floor, we called this guy Serpent. Now SRPT has jump risk or event risk. They're synonymous. And that means that if a stock's got jump risk, it could close at $50 and open at 80, or close at 50 and open at 10. Okay? Now your Apples, your Amazons, your Netflix, those aren't really going to have jump risk. Maybe after earnings, but they're not going to just jump on random news. But some smaller stocks definitely will, and SRPT is one of them. So 8/26/2012, I sent this email to a desk that I was managing of 5 market makers. Hey guys, Barron's ran a one-pager on SRPT. SRPT was quoted as developing a godsend drug for muscular dystrophy. Stock trades at 10.50. Barron's thinks it can go up to 26. Sent this around, recommended that we look to buy options in SRPT. Well, a couple of days later, there was a big call seller on the 14 strike. Now, when you're thinking about options, especially if you're not too familiar with options, I would just think of if you're buying calls on the 14 strike, you're buying stock at 14. That's all you're doing. Why would you buy stock at 14 when it's trading at 10.50? Well, you get massive leverage to do that. So just start to think buying calls at 14, you're long stock from 14. Well, a couple of days later, SRPT 14 calls came in. I bought 40 of them for 30 cents. The rest of my desk took the balance. It was a 200 lot that came in. The risk, if I'm buying those calls 40 times for 30 cents, is $1,200. Now, when you're buying out of the money calls, out of the money puts, if you're just buying options, you can't lose more than you bet. So my risk on this trade is $1,200. A couple of days later, we came in and SRPT gapped up to $40. And we knew the stock's got jump risk. We were thinking it would go to 25, 20, but it gapped all the way to $40, ended up making $104,000 on the trade. Needless to say, I was very excited after this and became somewhat obsessed with trying to find these little options. And the markets were getting tighter and tighter, so technology was actually helping this approach. This is what I found, and I started working with a proprietary fixed income firm in 2003. I was the 6th employee. We grew it up to 150 people, and I trained in excess of 70 traders. And what I found is on the left, stock market efficiency, and on the bottom, years. And I would say take it out to 20 years. Now, stock market efficiency, you could put your own business in there because the market is going to continue to grow. Every year, it's getting more efficient. There's dark pools. There's automated trading. The market's going to continue going forward. Now, traders, represented by the green line, from my experience, they make money sometime in their career, and they don't really change their game up. They don't really change and keep up with the growth of the market. Instead, they have stubborn behavior, and they think that it's a bad trade, and the market should be coming back to them. Well, that's not really how it works in business, and that's definitely not how it works in the market. I trade completely different than I did 4 years ago, 2 years ago, 6 months ago. Okay, so we have to constantly change our game up and grow with the overall market. So who is this approach for? I trade about 10 or 15% of my account using this very strategy. It's a fresh approach that, in my opinion, or at least that I've seen, nobody else can teach you. And also, if you hate staring at the market all day, or if you can't stare at the market all day. Michael, you're getting some echo coming back? I just turned down my sound. Hopefully that helps. Also, this trades for any size account, because what we're doing is we're just buying options. So instead of buying a 10 lot for 40 cents, which is $400, you could buy one lot for $40. You could paper trade and learn a new approach. Learn how to trade options. So swinging for the fence is the strategy. Again, beginner friendly, absolutely no options knowledge required, and we'll learn how to trade options correctly. What we're trying to do is we're trying to find cheap options, and cheap, let's call them less than 40 cents or maybe 50 cents, and we're looking for big returns. Lastly, technology really benefits this approach. I don't know very many other trades, that are on the right side of where technology is going in the markets. Risk, we can never risk more than we bet. No surprises. Bet small or bet big, we can only lose what we buy. So in that example of buying the 14s for 40 cents, I could only lose $1,200 if I do that 30 times. So a quick talk about mental accounting, which comes up and I think that people don't give enough respect to in trading. So mental accounting, a little story that's Vegas folklore. Husband and wife go to Vegas. They bring $1,000 to gamble with. After the first day, they lose all their money. They go upstairs to go to sleep. The husband wakes up in the middle of the night, finds a $5 chip on the bedstand. He takes the $5 and goes down and plays roulette. He takes that 5 and puts it on number 18 and it hits. He wins $175. Now he keeps doing this. He builds it up to $6,125 and eventually $7.5 million. Finally, he takes the $7.5 million, puts it all on number 18, and the ball lands on 19 and he loses his money. Dejected, he goes back up to his hotel room. His wife asks where he's been. He said, I was downstairs playing roulette. Oh, really? How did you do? Not bad. I just lost $5. Now this kind of silly story, which is Vegas folklore, talks about the house's money. When people say, oh, I'm on a hot run, so I'm going to start playing more. Or why people spend more on their credit card versus when they have cash in their pocket. And we don't think that it does, but it plays into our trading so much, where people have a certain methodology and then they make money on a couple of good trades, luck or not, and they decide to change their strategy, or they get really confident, so they don't stick by their methodologies anymore. I see this playing through all the time. Next 3 slides, just basic options knowledge. Everything we'll need to understand the strategy. Now, buying versus selling options, and this is on a grand level, let's say. So people usually either like to buy options or they like to sell options. The people who like to buy options, you can expect to lose 70, 80, 90% of the time. But when you win, your winners have to be greater than your losers. Whenever you buy an option, calls or puts, you're long volatility. You want movement. You need movement. Now, selling options is the opposite. When you sell options, 90%, 80% winners, but you got to watch out for those losers. When you lose, you're going to lose 10 to 20% of the time, and then obviously you want to lose less than you win. And whenever you sell options, you're short volatility. And that's the risk profile for people who buy. Like if somebody just said, oh, I like to buy options. Well, I would assume that's their risk profile. Same thing, selling options. I could sit here today and say, hey, I've got a trading strategy. We can make money 99% of the time. Well, how dangerous does that sound? Because who knows what's going to happen on that 1%. So that's why those kind of talks and options, watch out for, because they're just nonsense. You have to find something where you can trade good value. Different personalities like to buy, different personalities like to sell, but don't get caught up in anything that you think you can win 95% of the time, because that 5% is going to be very, very dangerous. Options valuation. Most people value options using the Black-Scholes model. That's, I would say, about 95, 97% of options valued on the street. The Black-Scholes model only has 5 inputs. That's it, to the whole model. Out of those 5 inputs, which are in front of you, 4 of them the market gives you. There's only one that the market doesn't give you. So if we're going to buy an option on Apple, we know what the stock price is on Apple. We know what our option strike price, that's right in front of us. They tell us how much time we're going to have with the option. We know what the risk-free interest rate is, 0, or whatever the 2 years at. But the only subjective component in all options valuation is volatility. And that's why it's the #1 most important thing to consider when you're trading and learning about options. Now, pricing. On the left, 2 days to expiration, and on the right, 30 days to expiration. Stocks at $20. Stocks at $20. So I just wanted to show how options are priced. $20. So the 22 calls. If we buy them, we're buying stock at 22, but we only have 2 days left to expiration. So most likely, we're going to lose money on this trade, going back to that 90%, 10%. But if the stock gets above 20 or above $22.10, we're going to be long stock from 22.10. With only 2 days, the 24s are worth 0 because that's a massive move without some kind of catalyst. 22 calls, I put that they're worth a dime. 18 puts worth a dime, only 2 days. But now watch what happens when there's 30 days. Those 22 calls, if we're going to buy stock at 22, now we have 30 days. They're going to charge us more than a dime to do that, right? Because now we have time. Time is in our favor. If there's 60 days, those 22 calls might be $2. If there's a million days, those 22 calls might be, who knows, $50 or $100. So that's how options are priced, all based upon how much time that we have and how much volatility. Now, for any options traders out there, can anybody tell me why the 22 calls, $1.20, $2 higher, 18 puts, $2 lower, I put $1.40. And the 24 calls for 40 cents, but the 16 puts are 60 cents. Couple of guesses. Nobody's hit it yet. Out of the money, time, intrinsic, implied, no. So the reason why, Wayne, mispriced. It can't be mispriced because I just made it up. So it's a phony baloney example. But Barry's close. So Barry says down faster. So the 2 most popular option strategies in the world, buying puts to protect your downside, right? That's why people use options. They want to buy puts. The other most important strategy, or the most popular strategy, are covered calls. You buy stock and sell upside calls. So think about that. If people are selling upside calls, those are going to be lower. If people want to buy puts, and I'm a market maker, and I know if I have a room full of 500 people want to buy puts and they want to sell calls, well, as an options market maker, I'm going to make my options reflect that. And what that's called is skew, S-K-E-W. And that's just saying the upside, this example, the upside is going to be priced lower than the downside. Now, the only industry that really prices the upside higher than the downside is going to be biotechs. Because biotechs, if they get approved, they have big jump risks to the upside. So biotechs are the only industry that really price the upside a lot greater than the downside. So that's why skew, S-K-E-W. So let's get into the strategy. We're looking for two things. We need stocks that move, but we also need tradable options. And I'll show you what that means. So stocks that move. Here's two examples. YRCW, 52-week range, high of 22, low of 11. Tata Motors, high of 51, low of 21. These are very volatile stocks. I'm a big believer when stocks start moving this fast and YRCW say it's at 12, what's the difference between 10 and 14 or 9 and 15? I just think these stocks are all over the place. It could be trading, it could make a big move on any given day. It's not like trading Apple. Apple has 50 analysts following it. It's the most liquid stock in the world. It's also the most efficiently priced stock in the world. When you talk about YRCW or Tata Motors, there's no analyst covering these guys, and they have trouble finding value, and that's what makes them so incredibly volatile. So the first thing we need is we need stocks that move. Next thing we need is tradable options. LNG, 68 cents at 84 cents. Not a bad market. I'd rather it be 70 cents at 72 cents, but 68 cents at 84 cents is not terrible for a very volatile stock. So that's it. Those are the two things that we're looking for. Here's another example. B square, BSQR, high 12, low of 6. Tradable options down here, 20-cent bid at 30 cents. When I was an options market maker, a stock this volatile, we would have been 10-cent bid at 60 cents. But now, because of the machines, the automated trading, they're making these markets extremely, extremely tight. So why I trade like this? This kind of trade, I do my work on the weekends, find stocks that I like or find options that I like, and then once you're in it, you're done. Because what we're doing is, if we're buying 20-cent options, stocks at 10, we're buying the 14 calls for 20 cents. There's no stop because options trade 20 cents, 15, 10 cents, 5 cents. So you can't really have a stop. So you put the trade on and then you're done. We're getting paid on higher odds than we're risking. That's what we're looking for. It's a very straightforward approach. It also diversifies our other holdings, because when the market gets crushed, like it's been getting crushed, our longer term portfolios are most likely having a difficult time, but our long puts, our long little puts are doing fantastic. So it balances out your risk. And again, we're on the right side of technology. So the process to learn, we teach you how to screen, how to find these stocks. After that, we check to make sure that they're tradable. And then we'll do some technical analysis to find good entry points, or to find if we want to do calls or if we want to do puts. Now I'm going to put on screen sharing and go to my Thinkorswim. My first time using the system, so I'm trying to make sure it works. Yes. Just open up my screen here. Does that look okay? okay? It does not look like it looks okay. Okay. Just give me a second, guys. I'm sorry. I'm just trying to make it so we can see my screen here. Just give me one more second here. Hey, there we go. Okay. So now, yes, we're getting into, thanks, Denise. We're getting into the mispriced options right now. I wanted to give a little background on options and say why I use this approach. Somebody was just asking if we're going to get into the actual study. So these are names that we're looking at. Zendesk. Zendesk, we can see in the last couple of days, it's just fallen off a cliff. Gone from 21 all the way down to 1440. This was a trade that we had 2 weeks ago. We suggested the 20 puts in Zendesk. The 20 puts 2 weeks ago were trading at 20 cents. We liked the strangle, which was the 22.5 calls and the 20 puts. So Zen is an exact kind of stock where we'll use this kind of strategy. Another one, CSIQ. Solar stocks. Solar stocks are flying all around. Hopefully everybody can see the screen okay, but you can see extremely volatile stock, but look at the markets. 20 cents by 40 cents, 30 by 50, 45 by 65. So still, you definitely can transact in these names. And if I take it to the chart and we look at CSIQ, we can see this is a really volatile name, okay? Going back a couple of months, a low of 14, high of 40, gets up to 31, back down to 17. So, Roy, we're having trouble seeing these. Sorry, guys. Definitely first time I've used Omnovia, so that's why I'm not so flexible switching in and out of charts. But the point is, what we're looking for, stocks that just fly all around that we can trade, okay? And then we teach you how to find those with a screener, how to make sure that we can find tradable options, use some technical analysis to decide, do we want calls, do we want puts, or do we want both? Okay. Let me go back to the PowerPoint because that I know presents well. The workshop. This is what we're going to learn in the workshop. A screener, how to find the names that trade cheap relative to their movement. Then how to find the best strikes to buy for each stock we find. Again, risk. We can only lose what we're willing to bet. Set it and forget it. We do the work beforehand, then put these trades on, and then we also talk about valuation. A couple of testimonials from our clients. This one I'm really proud of. I know it looks small. Jonathan, I'm trying to figure out if your option service is worth it. Help me with the math. I pay $297 for the service and I have a profit of $9,600. I know it won't be like that every time, but it sure is a nice ratio. These are my trading results after following you. Sorry, TTM, 100% profit is enough for a rookie like me. So I won't read each of these, but people have definitely had some great success trading these little options, and it's just a new strategy. Here's what you get. The workshop, Swinging for the Fences. It's a 90-minute on-demand class. It's yours. Watch as much as you'd like. Also included with the workshop is 30 days of my home run options trade service, which is every Sunday for 30 days. You'll get 5 options ideas using the Swinging for the Fences strategy that I sent to you. Retail $600, and we're doing this today for $297. And for those interested, activedaytrader.com/swing. It's all lowercase, SWING. And then after this, we'll go and open it up for whatever questions you have. So Mark's asking, what are the durations of the trades? I'm going to go back to that screen sharing. See how that works. Okay. There we go. Okay. So Mark is asking, what durations are the trades? Well, because we're looking for options that are under 50 cents, we're looking probably about a week out, 2 weeks or 3 weeks. So using Zendesk, that's a name that's on the home run option service this week. We would be looking 10 days out. If we start going into March, it gets more expensive, and then we'd have to go out to the 20 strike. 20 strike is considerably far away, so that we're not really looking for. So I would say the trades on average are 1 week, 2 weeks, 3 weeks. Another name that we're using this week, NAV, Navistar. And the same thing here. This is in the 10 days out. Stocks at 714, 7.5s, maybe for 50 cents, or the 8s, maybe for 20 cents. I always encourage my clients, if the market's 15 cents at 35 cents, let's be 20-cent bid. Let's be 25-cent bid. There's no reason ever to pay offers in these things. Just be patient, work your levels, and then if you get filled, great. We want the trade. If we don't get filled, then that's fine too. Rich, how much capital to start? Well, the cool thing about these trades is there's no margin, right? So it's you can trade with whatever you would need, and you could trade with $1,000 because if you're going to buy one 10-cent option, right, it's $10. So it's a matter of what you need to learn and get comfortable. But there's no margin. So again, it's not like we're shorting any of these names. You can see NAV, another one of these names that's just extremely volatile. And I personally have had great success with this because I just find that they're not being priced well. They're just kind of a lot of low-hanging fruit in this kind of trade because, again, this trade wasn't even available to the retail community 3 or 4 years back. Mark, the screener doesn't cost anything. During the, see if I can open this here. I use FinViz in the workshop because FinViz is just a screener that everybody could use. So I'll go to that now. If you guys haven't tried FinViz, it's a really great screener, FINVIZ. Of course I can't get it. Come on. Yeah, so we use in the workshop, there you go, FinViz. You don't have to sign up. It's free. I'm actually not logged in here, but if you just go to screener, and then right here it's got descriptive, fundamental, technical. You just open it up to all. And that's the screener we use in the workshop. Free, easy to use, everybody could use it. Do you need to have TOS? No, Ron, you don't need TOS. FinViz is not affiliated with TOS. Separate company, and really powerful screener. TJ is asking cheaper stocks. What price do we stay under? For the actual stocks, that we're trading, it's usually between $5 stocks to $40 stocks. But we don't screen for that. I'll screen for $5 to $100 stocks. But yeah, once you start getting to $80, $90, $100 stocks, it gets to be expensive, the options, and we really want the options to be under 50 cents. So I'd say in our wheelhouse is probably like $15 stocks, $10 stocks. Here's the performance of the home run option service for the last 6 weeks. So these are all, I don't know if you guys, hopefully that's showing through okay. Every week, a minimum of 5 names. And again, this is included with the workshop, Swinging for the Fences. We do this because I found the best way for people to learn is to go back, watch the workshop, watch it as many times as you want, and then Sunday, you'll get the trades, follow the trades, paper trade, do real small size, get a feeling for it, communicate with me, Jonathan at Active Day Trader. I talk to 20 of my clients every day, just sitting because I trade full time, so I'm always in front of the computer. And then after that, it takes 2 weeks, get a feel for it, and then we start working on how to manage those options positions. Because I think a lot of people trade options, they'll buy a call, and the way to get out of it is they'll sell a call. Well, that's not how I like to get out of options. I think you're putting yourself at a real disadvantage by only covering what you bought. I much prefer to trade to cover my options by using the stock. And so that's something that we work on once people get familiar with the foundation of the strategy. So yes, the screener doesn't cost anything. You do not need TOS. Roger is asking, does the subscriber base push the price of the options up when they put their orders in? No, I don't have those clients. It's really difficult to move a name these days. Even if we're talking about Zendesk in front of us, really didn't trade very much in February, but just coming from the market making world, you need firepower to really move these markets. And a couple of 10 lots or 20 lots or 5 lots isn't going to affect, if it's not going to move the markets of the market makers. They're just going to take down whatever they need to take down. It's not like we're coming in with 1,000 lots. Yeah, sure. Gary, no, we're not looking to build a stock position over time, but I'll walk through an example. If a stock's at 10 and we buy those 12 calls, regardless of the price doesn't matter. Let's buy those 12 calls. So if we buy those 12 calls, we're going to be long stock from 12. If the stock trades 13, instead of covering the options, if we have a 10 lot, we could sell 1,000 shares at 13 and we're flat. We're long the 12 calls and we're short 1,000 from 13. We have no more risks to the upside. And the only thing that we have on is if the market gets destroyed, we're actually synthetically long a put because we sold stock. And if the market gets hit, we can buy the stock back and go through that example. But do these picks have high historical volatility? Some do. These picks have high implied volatility. They don't necessarily need to have high historical, but they do need high implied. Mark, so give me a second to flip back and forth here. Okay. So, so Mark, the 90-minute course is on demand. You watch it as many times as you want. It's not one-on-one. And then you'll get the trade ideas, the home run option service for 30 days, and that comes every Sunday night. And then you're welcome to email me and as many times as you like until we understand the strategy. And yeah, and then kind of go from there. Michael's asking, do you give notice when to exit the trade? And this is actually, it's a good question. So we don't give notice on where to exit the trades for this reason. If there's 10 of us and we're all looking to buy puts in CSIQ in front of us, the chart, we're looking to buy puts. And there's 10 of us, but me, I'm long 3 stocks and I'm long 1 put and long whatever, 1 put position in CSIQ. If the market falls 10%, I can't cover my put in CSIQ. I'm long 3 stocks. My only downside protection I have is this 1 put in CSIQ. Now somebody else might be long 1 call and 2 puts. They can cover that put a lot more quickly than I can. So that's why I'm always talking about managing your overall portfolio. Some clients use this little option service just for the puts to manage their portfolio, to manage their downside risk. But I do always encourage people 1 call for every 1 put, 2 and 2 or 3 and 3. So trying to stay balanced. So it's a lot more difficult to give exits rather than entries. So entries make more sense to me. Exits, we're going to start thinking that we're either long the stock or we're short the stock. Gary, yes, so good question. So Gary's saying you're sort of using synthetic stock. Well, Gary, we're using stock, but we're using stock to limit the risk of our position. So these positions we are usually taking to expiration. So if they're in the money, they're going to be stock. So we have to sell stock. Sometimes we're just going to sell stock before they expire. TJ's asking if I ever use spreads. I do use spreads. In this swinging for the fences approach, we're looking for out of the money calls, out of the money puts, less than 50 cents, not looking for spreads. And again, a lot of times, the markets are okay. Like right here, say the 20s, 20 cents at 40 cents. Right, it's not great. I'd rather it be 26-cent bid at 27 cents, but the kind of volatility CSIQ has, and for as little coverage there is in the whole solar sector, they have a tough time valuing these things. So CSIQ, what's the difference between it trading 14 tomorrow or trading 20 tomorrow? I don't think that there's a lot of difference. I think it's just supply and demand and slippage in the overall marketplace just pushes these things around pretty significantly. Gary, you're an options trader, huh? Gary's asking if I'm delta weighting my puts and calls. No, I'm not delta weighting. So when you're delta weighting, you are trading volatility. What we're looking to do here is we're just looking to find little inexpensive plays. So depending on your overall position is how you manage your delta hedges. That answer is probably not for everybody, but I think judging from the questions, Gary's going to understand that. Albert, so if you buy a put, you can only lose that amount. If the market goes up from there, how does that work? So if a stock's at 10 and you buy a put on the 8 strike, for 40 cents, say you buy 10, that's $400. If that stock is above 8, those puts are worthless. They're valued at 0. So it just goes out worthless. It's just, garbage. You don't have to do anything. If that same stock goes to $7.95 at expiration, your put position is going to be automatically exercised. So now you're going to be short stock from 8, and then either stay short stock if that's your preference, or you just buy stock at $7.95. You lock in that little nickel and you're done. Jim, so it's a 90-minute on-demand video. All yours, not live, recorded. Watch as many times as you like. Then you get the trade ideas, that home run trade service. After the month, if you want to continue with the home run trade service, it's $99. If you don't want to consider it, just don't do anything. It doesn't automatically rebill. It's just, I'm having trouble getting back to my actual PowerPoint. That's why I keep just staying here. But it's $297 and activedaytrader.com/swing. And if anybody has any additional questions, please, Jonathan at Active Day Trader. Again, I'm pretty quick with the reply. Michael, yes. Just send me an email at Jonathan at Active Day Trader. CSIQ has 88% implied volatility. Okay, that's CSIQ is a fast-moving stock, and that's what we're really looking for. We're looking to be able to find cheap options in fast-moving stocks. So I don't mind that CSIQ has a 88% implied volatility. Okay, alone that really doesn't mean very much, but what we want that thing moving like crazy. You guys have seen maybe how Weight Watchers has been moving lately. WTW. Oprah got in, Oprah got out, Oprah lost some weight. It moves all around. This is a name we've been very active in because it took a while for the options to catch up to a proper value because this thing was moving so fast. So if we put WTW trades all year in a pretty tight range, and then all of a sudden exploded in movement, and it's got a tough time revaluing itself. They put volatility a little higher, they put volatility a little higher, and they keep doing that until they finally find the right value. But there was a time. Right. Gary, we talked about that with the Premier membership. One of the titles was for our video was Oprah lost 25 pounds and tanked the stock, which was great for us. But right, that just shows. So I'm not sure if everybody knows what we're talking about, but there was a press release that Oprah lost 25 pounds, and Weight Watchers went from 11 to 14. It's absurd. I mean, but that's what these stocks do. They don't really have the liquidity like those major stocks. So once we start seeing nonsensical news like that, it just creates opportunity. But is there any reason that WTW, just because Oprah got involved, goes from 7.5 up to 27.5? She just invested in the company. She didn't. So it went 4 times its value in the course of 2 weeks. I mean, that's right. The common sense. Let's take a step back. That just doesn't make sense. Mark. Home run, our service, we had WTW a couple of weeks. It looked like here, the 24th of January, $350 of risk, making $14.50. We've had a couple of really big winners. The Spyware, 800 of risk, $47.90. And lately it's been 2 winners, 3 losers, 3 winners, 2 losers. And you can see the whole, so here's the whole time actually. These are all 3 weeks out, January 18th, because January just expired, so we had to go into February for all the ones that didn't have the weekly trades. Michael, it's Jonathan, Jonathan, at Active Day Trader. So Mark, that's more of what we're looking for. We're looking $300 bets, that we can make 1,500 or 2,000. But especially in this kind of environment, when the market's moving all over the place, we're just looking for protection for our portfolio. So I don't mind if the market goes down 10% tomorrow, and I don't mind if the market goes up 10% tomorrow. But I just want to be protected. That's how I trade. I'm constantly managing my risk, thinking, what's going to happen if the market explodes higher tomorrow? What's going to happen if the market goes down a ton tomorrow? And that's why I think that I like using these little options as well. It's not my entire portfolio. It's 10, 15% of my portfolio, always using it for protection. And when the trade's good, maybe I'll get a little bit more aggressive in these things because they're fun plays, but it's not what I use for the core of my portfolio. TJ, good question. TJ asks, are calls easier to make money on than puts because of the skew? You know what balances that out is that the market goes down faster than the market goes up. And I mean, TJ, it's a really, really great question. But because calls are cheaper than puts, when the market goes higher, risk comes out of the market. So volatility goes lower. So when the market rallies, your calls are losing volatility, but you're right on direction. Now on the puts, even though they're more expensive, when the market goes down and you own puts, you're winning on volatility and you're winning on direction. So that's the difference. Okay, and hopefully, maybe thinking about skew and thinking about how options are priced like that, that makes a little bit more sense. That, you know what, when the market's rallying, volatility is coming out of the market. Everything's fine, right? If the market goes up 100 points for the next 100 days, the VIX is going to trade like 5 in that example. But if the market goes down 100 points, for all these days, the VIX is going to trade 100 because there's risk on the downside. If we go up, everything's fine. Roy, yeah, several have asked, can you buy the home run? Yeah, we do offer the home run option service. If you would email me, Jonathan at Active Day Trader. I've had a situation where people with no options experience will go right into the home run option service, and I don't think that's a good fit. I just don't. I think that that you need to have a certain level of comfort with options before you enter the market, whether with my ideas or with anybody's ideas. So that's why I prefer. So people, if that's an interest, you can email me at Jonathan at Active Day Trader. So that's more of the reason. Oh, cool. Roy, perfect. Just hit me with the email, Jonathan at Active Day Trader. How do we decide whether to buy calls or puts on a stock? A lot of it is we want a balance. We really want one call for one put. I think that's how this strategy works best. So you could either do one call and one put in the same name, but I also tell my clients the 5 options that we send out, all those strikes in the given expiration are inexpensive. It's not like you're going to see the $15 strike is inexpensive, but the 17.5 and the 12.5 are really expensive. It's all the same level of volatility, pretty much. So calls or puts, you just want a balance between the two, because when the market's going to fall, if the market falls 10%, everything has a beta of 1. So you really want to protect yourself. I find if I'm just doing 3 calls and no puts, you're adding more risk without getting the reward from those type of trades. There we go. Okay, right back to it. So yeah, activedaytrader.com/swing. And again, yes, it's on demand as well. So 90-minute class, watch as many times as you'd like. Gary, that's cool. I mean, you can definitely. Gary's saying his preference is to use a spread, and so the one thing about these type of trades is, back to, if a stock's at 10 and there's only strikes at 12.5 and 15 and 7.5 at 5, you might not be able to do a spread, right? Because there might not be great markets on that. Oh, thank you, Denise. I appreciate that. Denise just threw the link in the chat box. So yeah, Gary, I do a lot of spreads, but because these trades are a week or 2 week time frame, right? You just might not have the liquidity, and these options are cheap enough. Like if we buy a 20-cent option, we're not gonna. It's gonna be tough to sell a 10-cent option, right? So we might not be able to spread it, but you will be able to do little straddles and little strangles. And I've seen the great success as people really grow into the strategy and start to learn how to manage their options positions with stock as well. Amy, there's no reoccurring charge. It's $297 for the 90-minute workshop and then the home run service. After the 30 days, if you want to continue, it's $99. It doesn't auto subscribe. You would just go and subscribe, cancel anytime. Or not. By the end of the time, you'll be able to do the strategy. I have other clients who are real strong options traders, but just rather that I do the work on the weekend rather than them doing the work on the weekend. So that's good value for them. The trades are anywhere maybe up to 5 weeks, which are kind of rare, I guess. I would say it's closer to 2 weeks. Like because February expiration is next Friday, our positions, we have one position that expires this week, and the rest expire next Friday. Roy, we buy calls. We buy calls and puts. Not really doing spreads. Sometimes you can do a straddle, but that's just buying an out of the money call and an out of the money put. Mark, yeah, that's fine. All right, I think I'm getting close to my time here. Just want to thank you. Thanks for having me, Josh. I really appreciate the introduction, and Denise working with you guys as well. And thanks for all the great questions, guys. Yeah, my pleasure. So if anybody has any additional questions, again, Jonathan at Active Day Trader. Happy to provide any kind of references as well. And there we go. Oh, great. Thank you. I appreciate everyone's kind comments as well. All right, guys. Thank you very much. Thank you, Denise, and thanks, Josh.